Alrighty, so we're right at time. Welcome everyone. My name is Colin Evans, and I'm part of the business development team here at Baird. And on behalf of Baird and your advisor team, I'd like to welcome you to this Baird Wealth Strategies meeting. Today, we're joined by Director of Advanced Planning, Tim Steffen, and Tax Strategist, Eric Wikstrom. In this session, they'll discuss things to keep in mind as you think about year-end planning strategies. But before we begin, here are a few housekeeping items. Number one, for optimal viewing, we suggest setting your layout to the side-by-side view via the circle in the upper left-hand corner, or excuse me, the upper right-hand corner. Two, all participants are in a listen-only mode, but we'd love to hear from you. Three, we will host a Q&A session at the end of the call to address as many questions as time permits. You can submit a question by clicking on the Q&A icon. Please be sure to address your questions to all panelists. This presentation is being recorded and will be available along with the slide deck following today's presentation. And with that, I'll hand it over to Mr. Steffen. Thank you for joining us today, and the floor is yours.
Thanks, Colin, and welcome everyone to the session today. This is the time of year where we start to focus on things like what's happened over the course of the last year, especially when it comes to new legislation. 2024, unsurprisingly, has been a pretty quiet year when it comes to legislation, with so much focus being placed on the election and the results of that and how that might impact things. But now that we're past that, it's time to look back and just see what might have happened this year. There's actually been a surprising amount of new developments that are affecting this year, not necessarily new things that were enacted this year, but things beginning to take effect this year. We're going to talk about a few of those. We did have one big piece of news from the IRS that we'll get into as well. And then we've got a number of other topics that we're going to dive into. So I'm going to just quickly show you our agenda. Oh, I don't have an agenda slide. We're going to begin by talking about just what's kind of new for 2024, some of the most recent updates on things, and then some of the legislative things, some of the things we're looking ahead to for next year, because 2025, to be honest, could be a very big year when it comes to legislative and other changes. And then we'll wrap up with my colleague Eric coming on to talk about some of the tried and true planning strategies that we're really focusing on with our clients as we head into the end of this year. So let's begin with just a quick status check of where we are for 2024. As we've all been experiencing, inflation has had a big impact on all of our lives and all aspects of what we do and where we spend our money. That's no different when it comes to changes in tax legislation. So we'll begin by just looking at our 2024 income tax brackets. So these are the brackets that apply to both ordinary income and capital gains for 2024. These numbers are up a fairly substantial amount from what we saw in 2023, thanks to the large inflation increases we saw throughout 2023. So these numbers are going to be up quite a bit. Just a couple of reminders on how these work. Ordinary income is the brackets on the left. That's going to apply to most forms of income that you have: wages, salary, business income, some forms of investment income, all forms of retirement income. So Social Security, pensions, annuities, IRAs, all of that. All that source of income is taxed at the ordinary brackets on the left. And as you can see, they start at the low rate of 10 and work their way up to 37% at the top part. One important thing to keep in mind with the ordinary income brackets is that everybody gets the benefit of the lower bracket. So your first dollar of income is taxed at 10% up to that $23,000 number for a married couple. After that, the next dollar of income is taxed at 12% up to the $94,000 level. And then the next dollar is taxed at 22, and so on and so forth. So everybody gets the benefits of those lower brackets, even though your income may land in, let's say, that 300,000 number, which is right smack in the middle of the 24% bracket. You still get the benefit of all those lower brackets as your income climbs through there. On the right-hand side are our capital gain and dividend tax rates. So these apply to long-term capital gains and any dividends that are considered qualified dividends, which is going to be most dividends that you get from stocks and mutual funds and that kind of thing. Those are taxed at an entirely different set of rates, starting at 0% for those at the lowest levels of income, and then working their way up to 15% and then 20%. So a couple big things to really point out here, make sure everybody's comfortable with. First of all, we talked about on the ordinary side, everybody gets the benefit of the lower brackets. Your first dollar of income is taxed at 10%, and then you work your way through those brackets. The capital gains brackets do not work that way. Your starting point for capital gains and dividends is wherever you leave off on the ordinary side. So for example, if you have $50,000 of ordinary income, you would find yourself in the middle of the 0% capital gain rate. And you'd have room to recognize some capital gains or dividends at a 0% rate. If on the other hand, your ordinary income is $100,000, Well, your ordinary income already exceeds the top part of the 0% rate on the capital gains side. So you're automatically in the 15% bracket for gains and dividends going forward. The other thing to keep in mind is ordinary income starts first. That's the first income that's taxed. Capital gains go on top of that. So while ordinary income can push capital gains into a higher bracket, capital gains will not push ordinary income into a higher bracket. Ordinary income is always going to be taxed first. We'll talk about deductions in just a bit, but remember, deductions are always used against ordinary income first, which is a good thing because that's the income that's taxed at the higher rate. These are the brackets for capital gains, for a married couple for 2024. For a single person, you can see the brackets here. They're very similar. In fact, the ranges for income are about half those for a married couple, at least up until about the 32% bracket or so. Once you get beyond there, then the brackets tend to converge and you get more income for a single person taxed at that 35% rate than you might have for a married couple, or a wider range of income, I should say. And again, capital gains brackets are also here as well. The 2025 brackets have been announced. We'll cover a few items from 2025 here coming up in just a bit. The inflation adjustments were not as significant heading into 25 as they were for 24. So these ranges will all go up again a little bit next year, but maybe not quite as big as they did for 2024. That'll be really evident on this next slide where we talk about standard deductions. The standard deduction is the flat amount of income that everybody gets that's tax exempt. It's the flat amount you can use to reduce your taxable income by. And here you can see the standard deduction amounts over the last 3 years, 23, this year, 24, and then next year. And you can see that in 2024, there was a fairly significant increase in most of those numbers. For example, for a married couple, the number went up $1,500 per couple. For 2025, the increases are a little bit more modest, about half that. That reflects the lower levels of inflation we're seeing 20 and 24 relative to what we've seen in prior years. But the numbers do still go up a little bit every year. So again, this is the flat amount you can use to reduce your ordinary income by to determine the amount that's actually subject to tax. If you are you may also be what they call an itemizer. There are certain expenses you can claim like charitable gifts and mortgage interest and state taxes. All of those combined can be more than your standard deduction, in which case you claim those. You're considered an itemizer at that point. But the vast majority of taxpayers, roughly 90% or so, still use the standard deduction, at least under today's system. Also note there are a couple of additional exemptions or deductions, I should say, that are available for those who are over age 65 and or if you're blind, you can actually collect each of those. So just keep in mind, retired couples will actually have a little bit larger standard deduction than a working couple. So these are the flat numbers we'll be using for 2024. A few other things to highlight as far as changes that are taking effect this calendar year. Retirement plan contribution limits. These typically go up a little bit every year thanks to inflation adjustments. That was the case in most plans, but not all. Roth IRAs and traditional IRAs did stay at $7,000. So no, they went up a little bit in 2024. They will not be changing next year, I should say. The catch up for those age 65, for age 50 or older for a retirement plan, that did stay at $1,000 again, so no increase there. So if you're over age 50, you're able to do an additional $1,000 to your traditional or IRA account. If you're doing, let's see, it says traditional SEP Roth IRA, that number should say 401k. Sorry about that. That second bullet where it says traditional / Roth SEP IRA, that should refer to 401k plans, SEP plans, SEP IRAs, that's right. So for SEP IRAs, the maximum contribution is $69,000. 401k limits did go up a little bit as well this year. They are up to $22,000 or $23,000 for an individual on 401k. So sorry about that. I got a little confused there. SEP IRA contribution, $69,000 this year, $70,000 for next year. Qualified charitable distributions, that's the ability to move money from a traditional IRA directly to charity, but a rule that's been around for a little while now. That amount did for the first time get inflation adjusted, so the annual amount there now is up to $105,000 for this year. Goes up a little bit more next year to $108,000. Health savings accounts also went up a little bit more this year and will be going up a little bit in 2025. Catch up for those remains $1,000. If you're not familiar with health savings accounts, one of the greatest savings vehicles we have available to us today. So if you have what they call a high deductible healthcare plan, you should be contributing to a health savings account. So the best savings vehicle we have available. Then lastly, on the estate planning side, the annual gift exclusion went up again this year for the I think next year it goes up again for like the 4th or 5th consecutive year. It's kind of unprecedented how that's been changing. The annual gift exclusion this year is $18,000. It was $17,000 last year, and it hits $19,000 again next year. Lifetime gift and estate tax exemption went up to $13.6 million per person, just about to be $14 million next year. We're going to talk at great length about the gift and estate tax exemption coming up in just a little bit, so we'll come back to those numbers a little bit later. Few other things to consider for 2024. So those are all the inflation adjustments that have taken effect for the calendar year. Let's talk some more now about new laws. I said before there was no new legislation this year, and that's generally true. Nothing real significant from a legislative standpoint. But we had a number of old laws that were enacted a few years ago that are just starting to really take effect in 2024. First one of those has to do with required minimum distributions. Remember, when you put money into a retirement account, it can stay in there, continue to grow tax deferred, but there comes a point where the IRS says now you must begin taking dollars out of that account. For most of us in our careers, that number has been age 70 and a half. A few years ago, it increased to 72. Beginning this year, we're going to start seeing it affect those at age 73. Now, technically, this rule changed a year ago. Last year was the first year where age 73 was the RMD age, but because of the way the law was written, nobody was really affected by it last year. This is the first year where those who turn 73 must begin taking distributions out of their retirement accounts. And we're talking about retirement accounts that are in your name. We're going to get into this whole issue about inherited retirement accounts coming up in just a little bit, so we'll keep that in the back of your mind. For your own retirement accounts, if you turn 73 this year, you must begin taking distributions out of there. Your first distribution must come out by April 1st of next calendar year, so you get a little bit of a delay on your first one. If you do push it off till next year, your second one has to come out by the end of next year. So you would have 2 RMDs in 2025. That may be appropriate for some people, but keep that in mind. Every RMD after your first one has to come out by December 31st of that applicable year. If you have a Roth 401k, those have in the past been subject to RMDs, but under a recent law change, they are no longer subject to that. So if you have a Roth 401k, while you certainly can take money out of it this year if you'd like, you're not required to. That puts Roth 401ks in a line with Roth IRAs. Another law, a set of laws that took effect this year, there are a number of new ways to access retirement accounts before age 59 and a half. Typically, if you take money out of an IRA or 401k before age 59 and a half, it's considered early. You have to pay an extra 10% penalty when you do that. There are a number of exceptions to that. And in this year, we saw a few new ones take effect. Quite honestly, most of those are the result of something bad happening to you. So while it's nice that this opportunity is out there, it's not something you want to aspire to. Hopefully that's not an issue for most folks, but there are some new flexibility for accessing money at age 59 and a half. One of the big law changes that took effect this year, and the one we'll spend a little bit more time on it, is this ability to take money that's in a 529 account and roll it into a Roth IRA. So let me just take a step back to explain what we mean by there. Many of you are probably familiar with the idea of 529 accounts. These are these college savings vehicles that have been around for a long time. It's the ability to put money into the account. Maybe some states give you a tax deduction, no federal deduction, but on the state side, you might be able to get some. And then when you take the money out and use it for college, it can come out completely tax-free. The concern people have had in many cases with these 529s is, what if I don't use all the money that's in there? My child doesn't go to college, goes to a less expensive school, maybe they get a scholarship, and they just simply don't need all the money in the 529. Well, in the past, if you took those dollars out, they could be considered taxable and maybe even penalized if you took it out and didn't use it for college. Beginning this year, however, we have a new ability to roll dollars out of those 529 accounts and into a Roth IRA. Now, as you might suspect, it's not quite as simple as it sounds. A lot of limitations and rules and that, so I'll spend a quick minute going through some of those. A few things to keep in mind. First off, the Roth IRA that you set up must be for the benefit of the same person who was the beneficiary on the 529. So if you funded a 529 for your child or grandchild, you can now roll it to a Roth for that same child or grandchild. This is not an opportunity for mom and dad or grandma and grandpa to reclaim those dollars that they contributed. They must stay in the name of that same student. There's a couple of timing limitations. You can only roll money out of a 529 plan to a Roth if that 529 has been open for at least 15 years. And also, you can't roll any money out of a 529 that hasn't been in there for at least 5 years on its own. So this is not a way to fund a 529 today and immediately roll it to a Roth. These have to have been accounts that have been set up for quite a while before you can move them into the Roth IRA. There's an earnings limitation, or sort of an earnings limitation. You must have earned income to be able to put the money into the Roth. So most Roth IRAs require you to have income below a certain threshold in order to be able to contribute. That ceiling does not apply on this conversion, but there is a floor. For you to move money from the 529 to the Roth, that student must have some earned income. But they don't if they have too much, that's not a problem. As long as they've got some earned income, enough to cover the contribution amount, you can roll from the 529 to the Roth. And that leads us to the last point, the contribution limits. There are 2 limits to keep in mind on how much you can actually move from the 529 to the Roth. there is an annual contribution limit, which is equal to the normal IRA contribution limit for the year. For 2024, that's $7,000. If you've already made a contribution to a traditional or a Roth IRA for the year, you're not eligible to do this rollover. This is a unique thing just for 529 for IRAs. If you put money into a regular IRA, you can't do this 529 rollover. And then there's also a lifetime limit of $35,000. These are relatively new plans, a new system, only available beginning this year. We're starting to see more and more of these things happen. Not all the kinks have been worked out of it. We're waiting for some IRS clarity and a couple things. But generally, if you have money in a 529 that's not going to be used for school, rolling into a Roth IRA can make a lot of sense. Taking a look at a new change that's coming in 2025, and this is a law that was enacted again a few years ago that's just going to be taking effect next year, is the ability to do what we call expanded catch-up contributions. There's always been a rule that once you turn age 50, you can put additional money into a retirement plan. We talked about the IRAs a little earlier, the $1,000 you can put into IRAs. Similar thing for HSAs. For retirement plans through employers, there's always been an additional contribution as well. And that's been $7,500 or so for anybody who turns age 50. Beginning in 2025, there will be a second catch-up or an expanded catch-up contribution, but it's very limited. It's only going to be for those who turn between age 60 and 63 in 2025. If you're not 60 or if you're 64 and older, you're not eligible for this. So it's a very limited catch-up contribution. But you can do an expanded amount rather than the $7,500 you've been able to do in the past. You get a larger amount. Actually, both of those have been adjusted for inflation this year. So this expanded contribution for 2025 is actually going to be a little bit more like $11,000 for those between ages 60 and 63. So something to keep in mind. That's all. That will be new next year. So as you're starting to do your planning for 2025, keep in mind if you're between the ages of 60 and 63, you can do additional money into your retirement plan next year. I mentioned before that there was one big change that came from the IRS, or big point of clarity, and this has to do with this issue of inherited retirement accounts. For those of you who have been following this at all, you may be aware that several years ago, Congress passed a law that created what we call the 10-year rule, a rule that says if you inherit a retirement account, in most cases, you must liquidate that account within 10 years of inheriting it. There had been a question, however, about what happens during years 1 through 9, and do you have to take distributions out of that account? Well, the IRS finally, after a few years of kicking the can down the road, did provide some clarity for it on that issue for us this year. So let's just kind of reset for everyone. If you inherited a retirement account, an IRA or other account pre-2020, so the owner died in 2019 or earlier, you continue to be subject to what are called the old stretch rules. You take annual distributions every year out of that account for the rest of your life expectancy. Nothing's changed for any of you. If, however, the owner of the account died in 2020 or later, you are now likely subject to the new rules. There are some exceptions for spouses and a few others. They continue to be subject to the old ones. But most beneficiaries, if you're the healthy adult child of someone who passed away and left you a retirement account, you are in all likelihood going to be subject to this new 10-year rule. And the question is, do you have to take distributions out of that account in years 1 through 9? The answer is, based on what the IRS has told us, is that if the person who passed away was taking required minimum distributions, then you as the beneficiary must also take minimum distributions. Now, they waived that requirement for the last few years. So while this rule actually took effect beginning in 2021, the penalties were waived for a few years now, and 2025 will be the first year when you have to actually start taking distributions out of these IRAs. So if you inherited a retirement account in 2020 or later, be aware that in all likelihood, you are going to have to take a distribution out of that account beginning next year. So RMDs can still be skipped for 2024. If you've been waiting for clarity on this, you still can avoid taking the distribution for this year. But beginning next year, you're going to have to. Keep in mind, there is no extension of that 10-year window. If your owner died in 2020, that account must still be depleted in 2030. So your 10-year window is really going to be more like a 6-year window. Also keep in mind that RMD amount is going to be a small percentage in most cases of what's in the account. It is not designed to liquidate the account. I would say in most cases, you're probably going to want to plan to take more than what that required distribution is in order to avoid a large tax surprise in the 10th year. This is a very complicated part of the law. Lots of alternative scenarios here, lots of exceptions to the rules. If you have an inherited retirement account, I encourage you to talk to your financial advisor. Make sure you understand exactly what rules you are subject to. Do you have to take a distribution for this year or not? If you're a successor beneficiary, you might actually have to take a distribution. So the rules are pretty complicated here. And if you have any questions with that, be sure to reach out to your Baird advisor and we'll help work through that with you. All right, so that's what's happening now for 24 and 25 and a little bit of what's happened in the past. A lot of the focus of what's going on from a legislative standpoint, though, is what might be coming after this year and as they head into 25 and in particular 2026. Now, why is that so important? Well, back in 2017, there was a set of tax laws passed called the Tax Cuts and Jobs Act. It was a large tax bill that was passed during the first administration of President Trump. Many of those provisions that were in there were set to expire and will be expiring at the end of 2025. We'll talk about the details of that in just a little bit, but it's left a lot of uncertainty as to what's going to happen to many of these tax laws we've been operating under for the last several years. So let's give you a quick overview of where we're at with all of this. So again, the bill is called the Tax Cuts and Jobs Act. Among the things that would be sunsetting after 2025, and this is not a comprehensive list by any means, but you would see across the board tax rate increases. I'll show you a little bit more on that in just a moment. About 2 to 4% at most income levels across the board. Standard deduction would fall. You saw that slide a few slides ago where we showed the large standard deduction. That number would be scaled back to about half or so of what it is. But you see a lot of our old itemized deductions start coming back. Things like the SALT cap, the $10,000 limit on state income and property taxes, that would go away. Mortgage interest would be easier to deduct, a higher limit on the amount of debt you can deduct the interest on. Your home equity loan interest would become deductible again. Your miscellaneous deductions would become deductible again. Things like investment fees, the fees you pay your CPA, business expenses you're not reimbursed for. All of those would come back if this sunsetting does happen after 2025. A few other things, your personal exemption would return. Remember back in the day when you used to get a deduction for yourself, your spouse, and your kids? That's been gone for several years now, but that could come back in just a couple of years. Alternative minimum tax, not all is good with the sunset provisions. Alternative minimum tax, AMT, a huge pain for many taxpayers, could become a significant issue for a lot of folks again. The child credit would fall from $2,000 to $1,000. If you're a business owner, you're probably used to something called QBI or the 199A deduction. This is a deduction that allows business owners to exclude up to 20% of their income from tax. That would go away in a couple of years. And then some big changes on the estate tax side. We'll talk more about those in a moment. Just to give you a sense of a couple of these might work, this would be this is a comparison showing you what the 2025 tax brackets and rates are, what they will be for next year, and how they would compare to what would happen in 2026. These are Baird's internal estimates of what those might look like if the sunset happens. And as you can see, if you just kind of look left to right, most tax rates would go up by about 2 to 4 percentage points. Now, the 12 becomes 15, the 22 becomes 25, on the high end, the 37 becomes 39.6. And then also the income ranges shift quite a bit. So income that's taxed in one bracket today might be in a much higher, or in a couple cases, lower bracket than what it is right now. Again, this is what happens if we get this full sunset. So if all these laws get set to expire at the end of 2025, as it's written right now, this is roughly what we would expect the ordinary tax brackets to look like for a married couple. Standard deduction, I said before, that would be falling quite a bit as well. So on the left-hand side is what we would project the 2026 standard deduction to look like in 2026 without sunset. And then what would happen if we do get a sunset? Again, these are Baird's estimates. These aren't written in stone. These aren't coming from the IRS. It's just our estimates of what might happen. But basically, the standard deduction would fall by about half at most income, or for most filing status, a little less than half. What this means is, for those of you who've been relying on the standard deduction for all these years, the amount of income you would have that is exempt from tax would fall quite a bit. Again, if the sunset happens and the standard deduction does fall back. The other area that we focused on when it comes to this is on the estate tax side. Some of you may have seen slides like this before at some of our other events. For those of you who are concerned about the estate tax, this is the tax that's paid on assets left to anybody other than a spouse or charity at your death. Right now, the exemption for 2025 for a single individual is just shy of 14 million. For a married couple, you get 2 of those, so just shy of 28 million. If we throw a 3% increase on that, those numbers would go up, as you see in the 2 columns here in the middle under the estimated 2026. But if we get the sunset, that exemption amount would fall by about half. Again, we're just estimating that. Nobody's published the numbers for 2026 yet, so we're just showing what Baird is estimating those would look like. What this means is that there's a significant number of people who today would be exempt from the estate tax, who in 2026 could become subject to it. And it could be, for many of those folks, perhaps a couple $1 million or more of additional tax that they would not be subject to today. We'll talk more about the planning around that in just a little bit. But This is one of the things that could happen if we see this sunset at the end of 2026, or 25, I should say. Now, I said all along, this is what's in the law. This is the way the laws are written today, is that all of these things would happen. Does that mean they're actually going to happen or not? Well, the reality is probably not, especially given the results of the election that just happened a few weeks ago. It now seems very likely that there is going to be a big piece of tax legislation introduced sometime in 2025. Could be early, given that the President Trump is going to have full Republican control of the Senate and the House. It's more likely that something happens maybe earlier in the year rather than later. But we do expect a significant piece of tax legislation to happen next year. What might be some of the things in there? Well, we haven't seen any bills yet. Nothing formal has been proposed. These are just some of the things that came up during the recent campaign. For example, President Trump has said he'd like to take all those individual and estate tax changes that were made permanent. So in other words, a complete extension of all the rules we've been operating under for the last 7 or 8 years. He made a reference to getting SALT back, that $10,000 cap on the state and local tax deduction. That was a centerpiece of the Trump tax cuts in 2017. He has talked about maybe repealing that particular provision and allowing full deduction of state income and property taxes. A lot of talk about making Social Security benefits tax exempt, as well as tip income and even overtime income, possibly making all of those sources of income tax exempt. Would those make it into a proposal? Remains to be seen. There's been talk about potentially increasing the child tax credit significantly. No proposals on changing the capital gains or dividends tax rates. We get asked that one a lot. Would capital gains be taxed at a higher rate under a Trump proposal? At this point, there's been no indication that that would happen, but we haven't seen any legislation yet. So we'll have to kind of wait and see how that might come over time. And then on the corporate tax side, one of the big pieces of the original TCJA lowered the corporate tax rate from, I believe it was 35% down to 21%. That's a permanent change. That is not going to change even if sunsetting does happen. President Trump has talked about even lowering that further to as low as 15% for companies who make all their products here in the U.S. Again, these are just things that have been talked about in the campaign trail. There's nothing in writing yet. We haven't seen any bills yet. That's something we'll be watching very closely throughout the course of 2025. And as we get more details, of course, us and your Baird financial advisor will have all the information you need to be able to start planning for some of these things. Regardless of what happens on the income tax side, we are still very focused right now on the estate tax changes. This is something we've been talking about for the better part of the last year or so, is what do the potential changes on the estate side mean for those who are considering doing some planning? So we've tried to bifurcate our client base into 3 groups as far as the importance or the relative planning they should all be doing. For couples who have a net worth of over $30 million, or singles at half that, so call it 15, if you are a couple over that threshold, you are somebody who's always going to be subject to estate tax. It's unlikely the exemption ever gets large enough that you won't have any kind of estate tax. So you need to really be considering what kind of planning you want to do. And in the event the exemption falls, you're really going to have an estate tax issue. But because of the size of your estate and the fact that the exemption is unlikely to ever get big enough to fully cover you, you should be doing planning in this right now. Take advantage of the laws that are in place today. Even if they don't change, probably good planning for you. On the flip side, if you're a married couple with a net worth of below $14 million, which we agree, that is the vast majority of households in the U.S., most people do not worry about estate tax. And if you're a married couple below $14 million, you don't have to worry about it today, and we don't think you'll ever really have to worry about estate tax. The exemption is unlikely to ever get low enough that you're going to have to be concerned about estate taxes. Doesn't mean you don't need to do estate planning. It's a lot of important planning that can be done as far as beneficiary designations, people to care for your kids in the event something happens to you, powers of attorney, healthcare directives, all that. You still need an important estate plan, but taxes probably aren't going to be your biggest issue. If you are in between those, or you're a married couple between $14 and $30 million of net worth, today you don't have any kind of estate tax liability to worry about. But if the sunset happens, or if some other change happens that does lower the exemption, and that's entirely possible, we expect it's going to stay where it is, but you never know what could happen. These things could fall. You're in a difficult spot because right now you have no estate tax issue to worry about. But if we get this sunset, you could have a multi-million-dollar estate tax issue you could be facing. This is where you need to really be working closely with your estate planner, your Baird financial advisor, to look at some of the different options that are out there for you. There are plenty of things that can be done between charitable giving, using life insurance to fund some of that tax liability, or even some transfers during your lifetime. There's a couple of unique techniques that are out there that people like to use. If you fall in that range, we should be talking today about what kind of strategies might make sense for you. Okay, so that's a recap of where we are right now, how things have gone throughout the last year, what might be coming up in 2025 and 2026. I'm now going to turn the baton over to my colleague, Eric, who's going to talk about some of the kind of more tried and true planning strategies that are out there, things that we talk about with clients all the time. So, Eric, I'm going to turn it over to you.
Thank you, Tim. Hello, everyone. Thanks for joining us today. My name is Eric Wikstrom, and I am a tax strategist here at Baird, and I work closely with Tim on concepts and strategies, just like we are going over today. So what kind of things can we do now with 6 weeks left in the year that could help you, your tax return, your tax situation, or potentially your just investment profile as well? So let's take a look. Excuse me. Sorry. There we go. Okay, there we are. So one of the basic things we can do, Tim showed a slide with the standard deduction. So we all have in a tax return, we all have income. We get to a point in it where we have some adjustments and we get adjusted gross income. At that point, we get the greater of a deduction, which is the standard deduction, which Tim talked about. And those standard deductions are based on filing status, single, married filing joint, married filing separately. We all have different standard deductions related to those filing statuses. But there's 4 itemized deductions that we all get, and that's medical expense, state and local taxes, interest expense, and charity. And charity, as you might imagine, is the one you have the most control over. So we're going to take a look at how you might be able to bunch some of those 4 itemized deductions and have them exceed the standard deduction and what that might mean for you. And all this really means is you have the control with your charity to perhaps bunch deductions, meaning group them in a certain year, maybe skip next year, and then have more deductions in a following year. So I know this table has a lot of numbers, but let's look at the top part here, where if we had income and property taxes, mortgage interest, and charitable contribution, and consistently had those amounts for over 4 years, and in the yellow there, if we made charitable contributions of $7,000 a year, our total itemized deductions would be about $26,500. Well, 2024's standard deduction is $29,200. So again, you get the greater of. So you would get the standard deduction of $29,200 because it exceeded your total itemized. And then the reality is your $7,000 charitable contribution would not be tax deductible. It's nice of you to be charitable, but ultimately it provides no tax benefit on your 1040 because you would have gotten a higher amount anyway. So if you go down there to the next table, next section in the table under bunching, and instead of $7,000 a year for 4 years, what would happen if we gave $7,000 and doubled up in 2024 and 2026? If we did that, we would exceed the standard deduction of $29,200, and our total itemized deductions in 2024 would exceed about equal $33,500. And then we don't pay any charitable contributions or have any in 2025, and we go back and use the standard deduction. 2026, we double up again, have 2 years effectively of charitable contribution equaling $14,000. We get the higher higher itemized deduction of $33,000. And if you look at that in the green bar there, if we did that every other year of bunching charitable contributions, our total deductions over 4 years would equal $125,000 versus not bunching up above, we'd only get $116,000. So you can see the concept is really simple, and all we're trying to do is get the greater of itemized or standard, and in order to get there, we have to double up some of the things we can control, like charity. So let's look at another one here, and people will come to us and say, well, Eric, I do get to itemized deductions. I don't see how this is going to benefit me. So if you look at the top part of our table under the pay annually section, you'll see that they had income and property taxes for 2024 of $10,000 and charitable contributions of $20,000. They're in the yellow. That equaled 30,000. They barely got over the standard deduction of 29.2. So they'll say, I am itemizing. I'm not sure how this is going to help me. Well, using the same logic we just went through, if in 2024 we said, hey, we really want to get you over the standard deduction, here's how we're going to do it. We're going to double up on your charity, just like we did before. So in 2024, let's do 2 charitable contributions of 20. That gives us 40. So now we're at 50 of itemized, and we're about 20 grand in change over the standard deduction, which will give us 50. Then next year we do the standard of 29. In 2026, we double up again. You get the idea. And if we did that over a handful of years, in green there, our actual itemized deduction would equal actual and standard, itemized and standard would be 158,000. And we would have far exceeded, just barely exceeding the standard deduction like what we were doing above, because that would have only given us 120,000. So bunching is a very easy strategy to invoke when we can control the one thing we can, which is charity. So again, all we're trying to do is maximize the timing of your deductions and looking at where you are relative to the standard deduction. We see people give money to charity, and back in the old days, before 2018, when we didn't have certain limits and the standard deduction wasn't nearly as high, a lot of people itemized, and the contribution to your college, charity, church, Girl Scouts was deductible. But here it's not, because the standard deduction was increased by the Tax Cuts and Jobs Act. So keep in mind, bunching of itemized deductions, in particular charity, can be very beneficial. Okay, another thing that we see a lot this time of year is converting a traditional IRA to a Roth IRA. And we love anything with the word Roth in it, Roth IRA, Roth 401k, because the earnings inside will build tax-free effectively. And when you take money out, that distribution is also tax-free. But how do we get from a traditional IRA to a Roth IRA? Well, we basically convert it. And that just means we're withdrawing funds from a traditional IRA and we're depositing them in a Roth IRA, just transferring them effectively. And usually we just do that inside of Baird. We make that transfer from a Baird traditional to a Baird Roth. But people think I need to sell stuff in my traditional to move it over because it has to be in cash. Well, it doesn't. If you're fully invested in your traditional IRA, you just instruct how much of that you want to be converted to the Roth, and Baird, we can move that over. Those particular funds or stocks, any amount of them we can move over. And you can also convert, for the most part, in a company 401k plan. This has been a relatively newer development of doing in-plan 401k Roth conversions. So if you have a 401k plan at your employer, take a look and see if they allow in-plan conversions. And that might be a good place for you to convert money from a 401k pre-tax dollars into Roth dollars within your 401k. And any future transfer from a Roth 401k, your employer, to a Roth IRA is just a transfer. There's no tax on that. So you might be able to accomplish a Roth conversion within your employer plan. You can convert any amount that in the past you've deducted. But I want to point out a couple of things. All the earnings that you convert, so whatever you want to convert, 20,000, 50, 100, you name it, you can convert any amount you want. There's no limitation on the conversion amount. But what you convert is taxed at ordinary income. And Tim showed an earlier slide where, as individuals, we only pay tax basically in 2 buckets, an ordinary income bucket and a capital gain bucket. And so the Roth conversion is moving money from your traditional to a Roth. That is taxed as ordinary income. Another thing that we really keep our eyes open for is if you're 65 and receiving Medicare, the Medicare premium, which is known as IRMA, so everybody pays a base Medicare monthly amount, generally now about $175 a month per person. But if you have higher income levels, that puts you further into this Medicare table, and you would pay a greater monthly IRMA premium. So we try to watch on the Roth conversion to make sure you're well informed that if you do want to do a 50,000 Roth conversion and max out your 12% ordinary bracket or your 22 bracket, that you really know how that affects your IRMA, meaning your Medicare premium. And unfortunately, we can't recharacterize Roth conversion anymore. That was a feature that was available a few years ago, but once you convert, you're stuck. You can't hit the go back button and rewind. So that's why we love to do planning, help you figure out what your current year brackets look like before you do a Roth conversion, because once you do it, there's no going back. What are some of the factors that we want to consider when we do a Roth conversion? We see this a lot. When you do a Roth conversion and say, I'm going to pick a nice round number, say you converted $10,000 in a Roth and you're at a 22% bracket, meaning you probably owe an additional $2,200 in tax. It makes more sense if you've got that tax money, the $2,200 you're going to either owe the IRS, if you've got that money in a taxable account already. Could be checking, savings, money market, a taxable account at Baird or elsewhere. But a Roth conversion is harder to justify if you have to go back into your traditional IRA or a Roth IRA next year, pull money out and use that money to pay the taxes. So we always want to make sure you've got outside money to pay the tax on the Roth conversion. So another thing to think about when you're doing Roth conversions is if you're at a lower bracket now, that's a great time to do a Roth conversion. So if you took time off from an employer, you retire, before you take Social Security, you may be in a trough year where your income is lower. And if that's the case, you may want to convert because your income's lower. And when you retire and have Social Security, maybe some required minimum distributions, your income's going to be higher. So we love to convert at 12%, and then in the future, you're in the 24%, you're taking tax-free Roth distributions. So we generally, you can convert at any time, any amount, but if you're in the 35% ordinary bracket, converting can be expensive, especially if you're estimating that in the future, you're going to be in the 24% bracket. So we keep our eye on where you're at now and where you're going to be in the future. Some other things to think about, delaying the accessibility of Roth funds makes the Roth more powerful. If you can put off putting your hand in that Roth cookie jar as long as possible, the Roth can grow and grow and grow, compounding on itself. If you have to dig into it all the time, you're just pulling the Roth balance down, and it's a smaller amount that it can build on. Also, we see a lot of people who do Roth conversions where they don't necessarily think they need that money. They want to make sure that money goes to their spouse, their kids, their grandkids, and they're willing to pay some conversion tax to get their beneficiaries tax-free money. Okay, tax payments is something that I spend a lot of time talking to people about because there's a real lack of understanding between the IRS and our education on when you have to pay into the system, meaning the IRS, under your name and Social Security number, when you have to do it and how you have to do it. But the IRS wants us to pay in a minimum amount of taxes to avoid what is known as the IRS underpayment penalty, and they charge an interest on that as well. So that's the first goal that we have, is to try to get you over the underpayment threshold so you're not penalized by the IRS. You may still owe tax on a higher year of income, but at least you won't have the IRS penalty. So the IRS has put in a couple rules to help us there, and we can pay in the lesser of 90% of current year tax. And again, as our comment there says, it can be kind of hard to estimate the current year while we're in it. It's always easier to figure out in the next year what our prior year tax has been because things are done. So we go through on a software program we love, and we help you estimate your current year tax liability to help you with this issue. But again, you can pay the lesser of 90% of current or 100% of prior year tax. The only caveat there is if your adjusted gross income is more than 150,000, the 100% number grows to 110, which is just 1.1. So if that's the case, we take your 2023 tax from your tax return, multiply that by 1.1, and that's one of the two beachheads we have to meet to avoid underpayment penalty. If 90% of current is tough to estimate, and we think income is going to be the same ballpark year over year, let's pay in that 110% number, and you'll be safe from any underpayment penalty. There is a annualization method for certain people. If you can, for example, realtors, residential or commercial realtors may do one transaction a year, maybe in December. They're not required to make estimated payments in April, June, September, because maybe they don't have any income. Maybe all their income came in December. Therefore, they can use a system called the annualized income method to try to put their tax payment in within one payment. But basically, we help you understand the tax payment system and how that works, because we don't like to see you overpay the IRS before you have to, because interest rates have gone up a lot. We'd love to have you keep as much cash in your pocket as possible, and you earn interest on it, as opposed to giving it to the IRS early, where they don't pay you any interest on the amount that you have voluntarily paid them too soon. So again, there's 4 ways to make tax payments into the system for your tax account. Number 1 is application of prior year refund. A lot of people don't know, on page 2 of your 1040, if you get a refund, you can apply any or all of that to next year's tax. But what most people do is say, I'm going to get a $6,000 refund. I want that in my pocket. But keep in mind, you can slice and dice your refund any way you want to have any amount applied to next year. And then you can also have some go in your pocket, but most people don't understand that. They just have it all paid to them. And then we see cases where it would have been good if they would have applied some of their overpayment from last year, would have helped them out of the underpayment penalty. You also have W-2 withholding taken out of your paycheck that you get credit for every 2 weeks or twice a month, how often you get paid if you're working. We also see withholding from an IRA or annuity. So if you get a $10,000 distribution from an IRA, you can request that 5, 10, 20% is withheld and sent to the IRS, and maybe 5% is sent to a state. So keep in mind, you can always do withholding from an IRA. And the 4th method is quarterly estimated payments. There's 4 deadlines: April 15th, June, September, and January of the next year. Now, people used to make estimated payments via mail. And if you can remember, a few years ago, not that long ago, people would take the paper copy of their 1040, and their CPA would give them some estimated payment vouchers. And literally, you would cut these off, and you would write how much you're paying, and you'd mail it into an IRS office. We recommend you don't do anything today with the IRS via mail. You do it all electronically. And off to the right there, we just show you a little screenshot of the IRS direct pay online system. Just go to irs.gov, and you can see this. The IRS makes it very easy to pay online because they want your money. Okay, know your deadlines. There's 4 basic ones. December 31st is an important one. Now, if you add an RMD, a required minimum distribution from a traditional IRA, and if you've been taking those over the years and you haven't taken one yet, you need to take it by December 31st. You can't kick that into the next year. You need to take it this year. If you're working and want to make a retirement plan, bigger contribution in your 401k, you need to somehow, if possible, bump that up by the end of the year, because you can't get your January W-2 and say, oops, I didn't pay enough into the 401k. I would have liked to have contributed more. By then it's over. Also, charitable contributions have to be done in a calendar year. You can't make those in the next year retroactively to the prior year. And Roth conversions have to be done in the calendar year. January 15th is the 4th quarter estimated payment date deadline. Again, 4 quarterly payments: April 15th, June, September, and January of the next year. April 1st is the deadline for the required minimum distribution date. We call this the required beginning date. So if you turn 73 in 2024, you should take an RMD in this year generally, but you don't have to. You can take your RMD for the age 73, when you start have to taking RMDs, you can kick the can on that till April 1st of 2025. The problem with that is then you'll have to take a 2025 distribution as well. So you'll end up taking 2 required minimum distributions in 1 year. And based on your situation, that may be too much ordinary income for you or more than you want. That could affect you in other ways, like your IRMA premium. So if you turn 73 this year, we encourage you to really consider taking an RMD if you haven't already. And then again, April 15th, everybody knows that's our general tax day, but the deadline to contribute to an IRA, a Roth, and a health savings account goes as long as April 15th. With that being said, you can get an automatic extension these days that takes your 1040 from April 15th to October 15th, right? That's great, but that doesn't give you an extension of time to make the payment. So a lot of times people say, I'm still waiting for information. Eric, how do I know how much I should pay? Well, you just have to estimate. And that's why a lot of CPAs will estimate high, and people will make high extension payments and then end up getting a refund, because it's better than not paying enough on an extension payment April 15th and then getting penalized. So again, the IRS will give you an extension of time to get your 1040 in, but not the payment. That's all what I had today. Wanted to thank you very much for joining us. We're always here to help you. So you can reach us through your Baird advisor. And we appreciate you being with us today. And Colin, I'm going to hand this back to you.
All righty. Great. Thank you, Eric and Tim, for your expertise here. And Tim, before you begin with your first question, I want to take a moment and remind everyone that if you'd like to ask a question, you can do so via the Q&A icon in the top left-hand corner of your screen. All right, Tim, if you want to start with the first question.
Great, thanks. So Eric, we had a question come in about qualified charitable distributions. Maybe you could talk about that for just a little second. I mentioned them earlier, the amount had gone up. Just explain real briefly what that is and how folks might be able to use that. Eric? Oh.
I'm sorry, Tim, I was looking at one of the things. Say that again.
We had a question come in earlier on qualified charitable distributions. So you can maybe just give us a minute or so on what those are and the limits and how those can be helpful for folks.
Yeah, thank you. So a qualified QCD, qualified charitable distribution, you have to be 70 and a half to be able to utilize that strategy. So if you're 68 and want to take money out of your IRA and have it go to a charity, you can't do it for that. You have to be 70 and a half, and you can't be before you turn 70 and a half. You have to be 70 and a half at the point you do that. But what it does is it allows you to take money out of your IRA, and instead of putting that on your 1040 as ordinary income, as long as it is sent directly to a charity, it doesn't appear anywhere on your 1040. And you can also use that when you're in a required minimum distribution phase, say at maybe you're 75 and taking RMDs, your required minimum distribution out of your traditional IRA might be 30,000. You can send all 30,000 of your required minimum distribution that would have been ordinary income. You could send that off to charity, but again, it's got to be a direct contribution. You got to do that through Baird. You can't take the money out, put it in your pocket, send it off to your charity. If you do that, it's going to be 30,000 of ordinary income. Then you'll get a deduction for it, as we saw in your itemized deductions, but you basically don't want to touch it. You want to send it directly through the charity, and you want to work with Baird to do that for you.
Perfect explanation. Thanks, Eric. We had a couple questions come in asking us for our thoughts on Social Security, and in particular, what's the status of the trust fund and what might happen in the future on that. I'll give you just a couple thoughts, and Eric, feel free to chime in if you get anything on there. The latest trustees report that was issued earlier this year says that the Social Security Trust Fund is scheduled to run out of money in about 2033, which is, it's been in that 33, 34 window for the last several years now. So that's not a big change, which I guess is bad because we keep getting closer to that, but the time doesn't get extended out. That is the point at which the trust fund would run out of money and technically Social Security would be bankrupt. Now, what does that mean? Well, what it doesn't mean is that benefits stop. It means that the savings that have been accumulated over the decades would be gone. But as long as there's still workers paying into the system, benefits will continue to be paid. They won't be as big as what they've been promised. The expectation is cuts would be in the 23% or so range, I think is what I've seen in prior reports. So benefits won't go to zero. Bankruptcy doesn't mean there's no benefits paid. It just means they aren't going to be able to pay the same amounts that they've been promising. Now, do we expect that would really happen or not? It seems incredibly unlikely that Congress and government is going to let the Social Security Trust Fund run bankrupt. This is one of those things that rarely gets talked about. I don't think it ever really came up during the most recent campaign. Every once in a while, somebody will mention it. But quite honestly, from a congressional standpoint, 2033 is a long time from now. Multiple elections between now and then, and it's unlikely that it's going to be a big priority for most people in Congress to really try and do something with that now. So the last time the trust fund came close to running out of money was back in the mid 80s, and it was literally months away from running out of money. I'm not saying it's going to happen again in 2033, but that seems to be the path we're on. So something's going to happen. There's no question they're going to do something, probably a combination of tax increases and benefit adjustments / cuts, whatever that may mean. But it's impossible to predict what that might be because nobody in Congress is talking about it right now. I don't know, Eric, if you had anything else you wanted to add on that.
Yeah, one thing I've read that could be a somewhat easy fix is that, just as a reminder, every employee pays 7.65% out of their paycheck. The employer pays the other half of that. But of the 7.65, 6.2 goes to Social Security, 1.45 goes to Medicare. But the Social Security 6.2 has a cap. It's always had a wage cap. And right now, the cap, I believe, in 2024, 168,000, and it's gone up and up every year, right, for inflation. So there's discussion that, like, why do we have a low wage cap like that? Why don't we have a wage cap at 300,000, 400,000? You capture a lot more Social Security as opposed to having it stop for the employee and the employer at 168,000. So I've read where they think maybe a digestible solution to help fund the system more is just raise the cap to 250, 300, 400, whatever, and have more people pay into the system that way. Whether that happens or not, who knows?
So, Eric, we got a couple questions that came in, going back to your comments on making tax payments and when you have to pay them and paying taxes throughout the course of the year versus the end of the year. And the questions came in similar bent. If you have income that comes at the end of the year, whether it's an IRA distribution or a capital gain distribution from a mutual fund, can you steer your payments to be larger at the end of the year to kind of match up with the income coming in, or do you have to pay that throughout the course of the year? How would the late in the year income affect your tax payment strategy? You
can use on the lovely form 2210, which is the underpayment penalty schedule. You can put down in quarters your income amounts. That may help. The one thing that we like about withholding, either from a paycheck, but I think we're talking about here IRA withholding. If you were to look, and again, the IRS wants its money throughout the year. So your first quarterly payment, April 15th, if you think of it like a clock, they want 25% of the lesser of 100% of last year or 90% of current. They want 25% of it by April 15th, 50% by June 15th, 75% by September, and 100% by January 15th. So we see a lot of people, when we look at that, they're underpaid up through the third quarter. And so they're going to do an IRA distribution, but instead of taking 20%, we suggest take 40%, send that off to the government, because withholding is treated slightly different than estimated payments. And withholding can kind of make up for underpayment sins, because the IRS assumes that withholding is paid ratably throughout the year, as opposed to an estimated payment, because the IRS knows when you made that third quarter estimated payment on September 13th, they know exactly when they got it, and they can tell you, oops, you were underpaid for that third quarter. Thanks for trying to catch up, but that didn't quite work. You're caught up now, but you might have been underpaid. So withholding can kind of cure all that because the IRS assumes it was paid throughout the year. So a lot of times we'll see people go to their employer, adjust their paycheck maybe once or twice, November, December, or they'll increase their withholding off of IRA distributions.
Perfect. Thanks, Eric. We had a couple questions come in related to IRAs. I'll try and knock those out quickly. One was asking about Roth contributions and catch-ups. Whether you're making a direct Roth contribution or a catch-up contribution, there are income limits that apply. So you need to have earned income to be able to make the contribution. But if you have too much total income, you can be phased out of the ability to make a contribution. So same rules apply to the catch-up as they do to the direct contribution. And then a question on RMDs. If you turn 73 in 2024, you're considered subject to RMDs. You do have to take an RMD for 2024. But because it's your first year, you have the ability to delay that until April of 2025, April 1st of 2025. So yes, you are subject to an RMD for 2024, but you have the ability to push it off into early next year. You will also be subject to an RMD in 2025, and that will have to be taken by the end of that calendar year. So if you push this year's into next, you'll have to take 2 of them next year.
Yeah, and Tim, as you said, people forget, they somehow think the April 1st rule applies every year, and it doesn't. It only applies that one time when you turn 73 in the year. For that, you get that option for that one time to kick that RMD to April 1st, but that's the only time you get to do that. You don't get to do that every year.
Correct. Okay. Colin, I see we're at time here.
Yeah, unfortunately we are at time, but thank you, Tim and Eric, for being with us today, and thank you everyone on the line for your time. If we were unable to address your question or you would like additional information, please feel free to reach out to your Baird financial advisor. As a reminder, this call has been recorded and will be available in about a week if you're interested in sharing with a family member or friend. And you can find that recording on bairdwealth.com. And with that, everybody have a great week.